Do you know why Alibaba is down over 70% from its peak? Well, the answer is not that simple. Alibaba has been hit by many problems at the same time, and that's why the stock price is so cheap. Despite all the risks that Alibaba has, I decided to keep investing in it. Alibaba represents a large part of my portfolio because it is a great opportunity at the current price. It's easy to say I only buy when the stock price is undervalued, but when the stock price goes down, there are a lot of problems with that business. You have to decide if it's something in the short term or in the long term. That's why you have to understand their business model, what opportunities they have, the risks, and see the fair value of that business. When you know all those things, you can easily make decisions about when to buy and when to sell. So let's start with their business model, or better said, their ecosystem. Alibaba is a holding company that has many businesses, as you can see in this image. Now, don't be intimidated by this complexity. Their main focus is on e-commerce, logistics, and cloud computing. The rest of these businesses are strategic investments that help Alibaba build this moat. The first main segment is China commerce, where Alibaba has a lot of platforms. The most important ones are Taobao and Tmall, that make a lot of money. Taobao means search for treasure in Chinese. Think of this platform as Instagram, where people go and see a lot of product content. Taobao connects merchants with consumers. You can create a store on their platform as you create an Instagram account, but instead of sharing your personal photos, you share the products you wanna sell. Now, Alibaba makes money by providing advertising services to merchants and other businesses. They also charge transaction fees, but for specific businesses, especially on Tmall. Moreover, Alibaba sells directly to consumers, various food products, beauty products, and so on. Much of the revenue comes from the services they provide to merchants. Tmall is for large businesses, brands, and other major players that wanna sell in China, for instance Nike and other major brands. In addition, Alibaba has a wholesale platform called 1688, where it connects wholesalers with businesses, and Alibaba makes money from advertising services, plus other fees. The same for their international e-commerce segment. You may have heard of AliExpress, that connects Chinese merchants with international consumers. By the way, I tried this platform and you can find a lot of cheap and good quality products. The other segments are local services and digital media. Those businesses help Alibaba provide delivery services to merchants and businesses that sell on its platforms. And digital media creates content to engage users on Alibaba platforms, to buy more from merchants and spend more time on its apps. The more users they have on their platforms, the more money they can make from advertising. Another important segment is Alibaba Cloud, that provides infrastructure services to various businesses, especially in Asia. For instance, if a business needs computing power, it can use Alibaba Cloud and pay only for the resources it uses, and of course for the duration. It's like a subscription service that depends on the client needs. You can see the segments better in this image, and which has a bigger impact on the revenue. As you can see, China commerce is the biggest, and it's the only one that is profitable. The others have to grow. Alibaba is investing a lot in expanding these businesses. Now, let's see their opportunities. Their goal is to serve 2 billion users globally by 2036. Alibaba now has about 1.3 billion active consumers worldwide, so they may achieve their goals sooner. According to their latest conference call, their CEO Daniel said that China's GDP is expected to grow by 5% a year. If that continues for 10 years, then Chinese people will have more money to spend on products. Thus, Alibaba's revenue will increase with the economy. He also said that he sees great opportunities in cloud computing. He said that IT spending as a portion of GDP is just 1% in China, but 5% in the US. Now, if you look at the statistics, you can see that e-commerce is expected to grow by 15% a year in China, and cloud computing by about 20% a year. So there is growth in both industries. Now, there are other things that can increase the value of Alibaba. The first is buybacks. They have about 21 billion left to buy back their own shares. They've done a lot of buybacks in the past, as the price has been so cheap, so you can have a 10% return only from buybacks at the current market cap. They may increase that amount if the stock price stays cheap or goes down even more. Another opportunity is that Alibaba may be listed in Shanghai. This means there will be more buyers who want to invest in Alibaba, and when demand grows, the stock price goes up. Ant Group may try to go public again. The first offering was stopped by the Chinese party because Jack Ma controls two major companies in China and he threatened the financial system, and because of that he got a lot of problems. Jack Ma has divested his control of Ant Group, but Alibaba still owns 33%. So if Ant goes public, Alibaba will benefit from this possible IPO. Now let's see the risks. The first risk is the VIE structure. China doesn't allow foreign investors to own its assets, only profits. Alibaba is incorporated in the Cayman Islands and has an agreement based on the VIE structure to control the subsidiaries in China. Now, that agreement depends on China's regulations. If the Chinese party wants to change the rules, they can do it anytime. This is the main risk. Moreover, Jack gave a wonderful speech and said how wonderful the Chinese Communist Party is, and because of that, he got a lot of problems. Now, let's think backwards. What will happen if Alibaba loses its agreement with that VIE structure? Well, first, investors will lose all their money, but China will lose even more money, because nobody will ever invest there. As Alibaba is so famous among investors, China has to be very careful about how it behaves with investors. If they want to attract more money to their country, they have to take care of investors. Another risk is delisting from the US. Foreigners are not allowed to perform inspection of accounting. If Chinese companies don't comply with the US, they may be delisted. But they got approval and can currently inspect Chinese companies. Now, if other problems arise because of this US-China trade war, then you have to be prepared. Make sure your broker is able to convert your ADS shares into ordinary shares that are traded on the Hong Kong exchange. You can check out my broker in the description below. And of course, one risk that you can get rid of is China's regulations. New rules will come and may affect Alibaba. You have to analyze at that moment whether it's something in the short term or in the long term. Moreover, there is competition. You can see in this image that Alibaba has the largest market share in China. The problem I see is not from those players, but from Tencent, which has that famous app WeChat. It has about 1.3 billion users. And Tencent started offering e-commerce services. Merchants can open stores in that app and buy advertising services from Tencent. As e-commerce is growing so fast in China, many companies want to take advantage of it. It's not clear who will be the winner in the future, but for the moment, Alibaba has the largest market share. Now let's discuss about investing in Alibaba. The stock price went down so much because of regulations, the profits went down due to that pandemic, and now the stock is a bargain. Let's see how much you can make with Alibaba. I use their free cash flow in renminbi, of about 140 billion, and the fair value is converted to dollars, to compare it easily with the market cap. So the risk of investing in Alibaba is, if it only grows by 5% over the next 10 years, due to competition and others, then the fair value will be about 170 billion for a 10% return. This is the worst case scenario. Now, the upside, if Alibaba grows by 15% a year, then the fair value will be about 640 billion for a 10% return a year. And the normal case, if Alibaba only grows by 10% a year, then the fair value will be about 343 billion and the market cap is about 212 billion. So you can get about 15% a year on the current market cap if Alibaba grows by 10%. As China's GDP is expected to grow by 5% a year, and you add 5% growth from Alibaba, this scenario can easily happen. Now, the fair value depends on the growth rate you choose. If you believe that Alibaba will grow even more, then the fair value will be higher. I don't know if Alibaba will reach 2 trillion in market cap, but at the current market cap, it's an easy double. And tell me in the comments, where do you see this business in the next 10 years? And if you find value in this video, please give a like and subscribe to see more videos like this because I want you to succeed.